Hello, everybody. Welcome to XM live trading session in the beginner's room for risk management course with me. My name is Junaid Wahid, trader analyst in Forex instructor. Started trading back in 2011 using fundamentals, sentiment, and price action in my analysis. My trading style is price action, swing trading. Also, I do trade intraday. Big hello to all of our YouTube viewers that are watching the session now. If you guys have any questions, you can be active in the chat. You can ask all of your questions in the chat, so I'll try to answer them. Our viewers in the XM uh, website, also big hello to you guys. Looking forward to your comments, questions. If you have anything related to risk management, trading, price action, latest developments, fundamentals, technicals, anything you have, feel free to share them with me in the chat. I will be very happy to discuss them, to share my opinion, maybe do analysis or live trade. Okay, so what is risk management for those that are just joining the session and are beginners and they don't know much about trading, just trying to learn something? Risk management, as the name suggests, is managing some risks. Trading, it's a risk-taking business. So you are looking for opportunities, but the way you generate opportunities is basically coming from your knowledge of market analysis. So you are analyzing the market somehow, that helps you to filter out informations and funnels it down for a down to trade idea. But the problem here comes that how to analyze trade in the markets. There are specifically designed sessions here in the XM Live project that you can learn how to analyze markets through a variety of different ways. As I said, fundamentals, technical, sentiment, so many different ways you can use to analyze the market and generate trade ideas. But you need to know and be expert or be master on some of the ways like price action, technical indicators based, fundamental based, sentiment, all combinations or anyhow. So the better you become as an analyst, the more ideas you can generate for trading. So first you are analyst, then you become trader. After you generate a trade idea for trading, then you are testing that trade idea before you trade it. How you test it? Using some risk management methods in order to see if this idea, what's the risk profile of this idea, what is the risk versus potential reward, how much you can risk per trade for that particular position, and does it make sense? All of these questions will be answered again if you have knowledge about risk management. So risk management helps you to control your emotions and maintain discipline. How? You are controlling your emotions thanks to the rules and information you did before, the job that you did before. Like an analyst, you analyze, you generate trade idea from your analysis, which is direction control, which is reducing the risk management, reducing the risk from um, direction risk in the market. Like you have higher probability that the price is going to go for certain direction, then it goes down, which is reducing the risk. Then you test that with different patterns, ways to um, confirm the position, risk management, risk to reward ratio. Is if it's a strong signal, maybe you value your entry strategies based on the patterns you have. Then all of the next steps that are coming are basically based on how did you generate trade idea. And the last filter is the risk management. Okay, we manage that risk because it's very essential for long-term success. The key tools that we can use in risk management, especially if we are beginner, it's stop loss, take profit, position sizing. After we did all other job that we had to do until we come to the entry level. Okay, so but these are the way that are helping us. The position sizing, basically, we are doing it ourselves with certain formulas that we have. They are very simple and easy, and many of the very experienced traders are basically doing it very fast because it's simple mathematics, and it becomes kind of a habit. Like, X amount of pips, stop loss, kind of you are rounding the lot sizes. I've seen many times this. Yes, of course, it's good to be accurate with your lot size because this is your exact position size. That is not higher than you can the money that you can risk per trade for that particular moment, which is your risk appetite for trade or risk tolerance overall. So it's very important to always be in that risk tolerance, not break it more. If you break it, then you can be in trouble psychologically. Then emotion control dies. You won't be able to control your emotions because um, you are risking too much, which is more than you can afford. That triggers emotions. If you risk significantly less than you can afford, which is, let's say, if you can afford $100 per trade and you open $7 risk per trade, you see the big difference here? Huge difference. This is classic standard risk that you can afford to risk per trade, but you are doing 7, 10, 17. That is significantly lower amount than you can generally risk. This usually is getting very boring for the traders, and which leads to higher than standard risk, believe or not. So if you use huge risks, that might at some point lead you to come back to the unnecessary small risk, and vice versa. Unnecessary small risk can bore you so much at some point that you can increase the risk significantly just to compensate that boringness you had. Well, that happens. I'm not saying that it's going to happen to everybody, but it happens a lot in trading. So you need to find your great average risk, zone risk per trade. It should not be one single dollar amount or X percentage. I always say that it's good to have some range to move in between. Why is that? Because some of the trades are really great, really strong, that you will trust, you will open, you will go for the full risk tolerance, but some of them are less confirmed. You still want to get it. You are supporting your strategy or following your strategy fully, and but they are not better than uh, most of signals that you are tracking. Then you can reduce the risk. Instead you take $100 risk, you might decide to go with $50, with $30, with $70, but you need to define what's your minimum risk that you can do, and maximum as well, and why. You need to define your whys. You need to know why you are risking 100%, because that's a best strategy, best entry, best confirmation. It's your sniper entry. Why you would risk 50 or $30? Because it's not good confirmation, didn't confirm early entry. You need to have your reasons. If you don't have, if it's not defined, I assure you that you're going to make a lot of mistakes, and you're going to trigger a lot of emotions by no reason, just because you didn't have any definition and did things by feelings. Okay. In this technical side, after all the analysis, all the interpretation, all the funnels, all the filters you did, then it all comes down to um, it all comes down to technical things that are rules you predefined and you just follow, right? They all have definition. You just go and confirm them. Check mark, boom. This is perfect for $100 position. Check mark. All right, this is problem. Better to go with lower risk. And over time, we can have scaling in add-ons, pyramiding method, whatever. So it depends on how deep you are into risk management and trade management knowledge, right? So that's simply why we do risk management and why that's important. Um, so I'm going to show you a couple of examples, real examples from the recent trades we did. At the same time, I'm checking if the stream is live. Yes, stream is live. Everything is fine, guys. If our YouTube viewers have any questions, feel free to share them in the chat section, guys. I'm also trying to follow technical friends. Yeah, okay, it's all open. I might get your comments and questions also. Okay, guys, if you have any questions related to risk management, let me know in the chat. My questions to you for related risk management is, what kind of risk management are you using, guys? Okay, we all try to guess directions. We try to find if gold price is going to go up, if it's going to go down, if Bitcoin price is going to go up, if it's going to go down. We try to generate ideas. We try to decode the puzzle of the market, patterns. We use trend analysis. We use some candlestick formations. Everybody having different approach to generate trade ideas. But what then we do? What is your risk management? Do you have specific rules, simple or not so simple rules that you are managing your risk? What's your risk tolerance? Let's go down to stop loss orders. Let's see, how are you placing your stop loss orders, guys? Do you have specifically designed way rules on how to place stop losses? Is it based on price action? Is it based on your market analysis, like patterns? Based on what you decide to place your stop loss, the place you place your stop loss. Is it based on X amount of pips or something? Because I've seen many different type of stop loss placement. That's super interesting to know, guys, that we can discuss if you want. I can show my ways or couple of different ways of stop loss placement that can help you or give you idea or food for thinking, could be food for thinking for you. Take profit orders. How do you define which level is going to be your take profit? Or do you have levels to exit from your position in profit? Is it something pattern, completion of the pattern exit? Is it support and resistance levels? Is it pivot points? Is it technical indicators? What is actually giving you the idea of how do you exit your position? Can you predefine that? Can you see that your profit is going to be bigger than your loss before you take a trade? Or it's quite random, whatever it comes. It's actually the approach. Can you measure your risk to reward ratio? Are you guys measuring your risk to reward ratio, or you don't pay so much attention to this risk to reward? You try to be strict with your stop loss and take profits as per the strategy and just try to have high accuracy to hit more targets than stop losses. And that's how you try to become successful if you are not still. And what's the risk to reward ratio in your trading? Does it taking place in your trading? This thing, call it risk to reward ratio, for how much money you are making for what you are risking. Okay, simply. And do you actually focus on position sizing? Do you have some way to position size your trades, to size your trades, or it's quite random? What I have seen, some traders are using the same lot size, regardless of where is going to be the stop loss, regardless of anything. They just use the same lot size looking to make pips. Are you from those traders that are using a random or the same lot size all the time and trying to make pips? Because the more pips you officially make, then you lose, the more profitable you are. So this is not about risk to reward or percentage success, it's pips success. So you make overall more pips than you lose and you are profitable. This is also some way I have seen. Some traders are just going with percentage. They say, I'm not going to risk more than 1%, and their risk is 1%, not more, but exact 1%. And they go to try to make 1%, 2%, or higher, or maybe some lower, 0.5%. Some people are making, some people are looking to make less than they risk to have more accuracy and make more profits than losses. And they are happy with this, even though I have negative, you know, um, seeing about that. My opinion about this is quite negative, but this is just my opinion. I could be right for me and wrong for you, for somebody else. How you position size, if you do? Are you using indicator? Are you using some specific add-ons in your platform, or you are using XM calculators? Is there any way you do that? And do you try to be very precise with your position size, or you just use averages? And do you like to diversify? Diversification is term that being used in investing mostly, but it can be actually taken out as a logic for trading where you are having huge exposure on the correlating instruments. Last week, we've discussed about this when we were buying euro dollar, sterling dollar, Aussie dollar, NZ dollar, and selling dollar yen, dollar Canadian dollar, and dollar Swiss franc. We actually don't trade separated trades. We are betting on weak US dollar that way, or vice versa. If we sell everything against dollar, we are actually betting on strong US dollar. And instead we use 1% risk for every single position. So we make 6, 7, 8, 4, 5% risk overall, that the result most probably is going to be the same for most of trades in direction wise. Instead we do that, we can reduce our risk exposure for the correlating instruments and understanding it first, and then we can split the risk. Instead, we multiply the risk on these instruments. So we've learned it last week. And this is where we can actually have also some diversification in between the trades at the time that we are opening them, where we have non-correlating instruments. We can buy, let's say, sometimes gold, and we can buy dollar at the same time. So we can now we can have like if gold goes up,